Okay, let me get the disclaimer out of the way. Disclaimer, not financial advice, only my own and other speakers' personal opinions. This is not to encourage nor promote taking any trades, positions, or investment of any kind. Any information contained in this conversation is for informational purposes only and to be taken as is. Derek Wong and other speakers have done their best to ensure accurate information. Regardless of anything to the contrary, nothing available in this conversation should be understood as a recommendation. Consult a licensed financial professional in your jurisdiction. This conversation will be recorded and posted for future reference. So I have quite a lot of notes. I know that the scheduling of this was my mistake, setting the link. So I will just start anyway, and we will have people trickle in, I'm sure. But the idea of risk and uncertainty is pretty much paramount to what we do and how we understand it. And I'm not just talking about volatility, because risk and uncertainty can be thought of simply as volatility, or at least that's what we believe is affecting our portfolio. It's the thing that we see affect the P&L. But I think that risk and uncertainty and its connection to volatility is much more philosophical. I guess I can just wax about it, but really the idea that first of all, that they definitely can be quantified, but some people take it discretionarily. And what do I mean by that? When you hear macro traders or people in the news talking about, oh, the market, has this uncertainty and then there's higher volatility, there is some kind of heuristic there that they're running. And I would say that's like this even, the man on the street knows that means that, the markets may or may not, do what you expect. And some people also look at that as like, is news reacting, how we expect? And that's from the position of a discretionary trader. For us as quantitative systematic traders, we have a lot more tools at our disposal to deal with this issue. And it also depends on how we frame ourselves. And, I did get into it today with Richard, but the idea was how we classify our ideas and what we can take as something we can hang our hat on. And, for him, I was saying that he knew something about these markets because of his large sample size. And I don't think that the induction of knowledge or deduction of knowledge method really matters, but that you came to a point whereby you can know something, or at least know something with some uncertainty. And the idea of this uncertainty is statistical as well as, innate. So, I have these things here. So we can quantify risk in a few ways as well. A lot of the things that we have talked about here in Jerry's Clubhouse, as well as the idea that Sharpe ratio doesn't capture what trend followers or systematic people are trying to do necessarily, depending on their styles. And that's because of the idea of how that ratio specifically is measuring risk, and that by proxy is the uncertainty of the performance. So in that regard, we have a few tools like scenario analysis, Monte Carlo. You can go into specific risks like the shape of the yield curve, the shape of the VIX curve, things like that, as there's different potential regimes that can play out when levels of either risk or uncertainty are high or low. In the uncertainty camp, some things I had written down. One is the communication of uncertainty. Our English language has some limitations there, and there has been work by Malbison, where he took a survey of portfolio managers and investors and said, what does unlikely, likely, very likely, possible, and a whole bunch of other descriptors. And there's wildly different ideas of what the probability attached to those means. And another way to think about uncertainty from a statistical standpoint is confidence intervals, distributions, the width of these distributions. And that kind of comes down to my fundamental understanding, or at least what I have been kind of proselytizing, I guess, thinking in distributions, thinking in probabilities, because if we can shape our language and we can shape our understanding of potential outcomes, ex ante, ex post, in the shape of distributions, it becomes quantifiable, but also we can put better words and language to our understanding of uncertainty. And this is, I think, a key factor in kind of the differences we see from the quantitative side of people and the discretionary, but also within our group, everyone here. And how we deal with that, we have certain tool sets, large sample size being one of them. Spreading, something that works across all markets is another way to reduce that uncertainty. So I think it's a very apt topic. It's very open. I will, as always, raise your hand if you have a question or would like to make a comment. As always, it's an open floor, and I will begin the room.
Thanks, Derek. It's very interesting what you said. So you think that risk and uncertainty are sort of synonyms. And I'd like to offer a slightly different approach, which is obviously entirely mine. So I might be totally wrong there, but I tend to make a distinction between risk and uncertainty, and where the line, sort of the divide, happens is things that you can measure, and measure by measuring I mean have pretty accurate measurements of, belong to the sphere of risk. Anything else is uncertainty. So, for example, barring some obvious knowledge gaps, but if I had to say, what's the likelihood that NATO will escalate with Russia and we're going to conflict, to me that's more in the uncertainty domain. Whereas, estimating the probability of certain things, certain price moves happening within certain confidence bands, as you said, within the confidence of some distribution, belong more to the, to the realm of risk. So, in my opinion, there's this distinction, but it's interesting you didn't mention it. So, how do you see this?
I do make a distinction, and actually, I think this discussion is helping me kind of clarify that. Risk is an adverse event, however you want to kind of classify that. I mean, adverse as in you've lost P&L, adverse to the way you're positioned, adverse to the world, as you mentioned in a geopolitical conflict. The uncertainty is the confidence interval around that. So, you could think of the idea of a VAR, value at risk is like, okay, 5%, this will happen, but what's the uncertainty around that? Then, they tried to adjust that by doing expected shortfall and say, okay, we can take, the integral of everything from, 5% to whatever and say, okay, this is probably what's going to happen. So I do think it's about a distribution. I do think it's about the uncertainty is the width of the distribution, and then the risk is the location of that distribution in regards to the negative aspect. And that does reinforce the idea that we should be looking, if you're looking at a trading system or something, that we should be focusing on the downside rather than the upside volatility. So it plays into that idea, but these things always go in hand. You will, if you have a risk, you will have some level of uncertainty because information is not perfect. So we're playing an imperfect game. That if you improve either of those metrics, as in if you improve your risk, you move that, risky distribution to the right or more positive, you've cut your drawdown overall. But if you can reduce your uncertainty, you reduce the width of that distribution, thus having even less of the negative outsized tail events. And then if you are more certain on your estimate, you're able to manage it better just because it becomes more consistent.
That explains it. And yes, I wasn't super clear myself, but I think we are once again aligned there in the fact that uncertainty is something that requires an extra effort with respect to measurement. And risk, of course, you're right. I mean, we don't really measure the probability of having an outsized or unexpected game. Perhaps we should, but we're certainly much more worried about the left side, the left tail, or the negative events. But yes, I think uncertainty then becomes very much aligned with my way of thinking. When you have lack of precision around your risk measurement up to a point where it sort of crosses a boundary and becomes very hard to impossible or even impossible to measure, then it's full uncertainty there. So yeah, it squares up with my understanding of it. Thanks.
I want to paint it with broader brushstrokes because the uncertainty can also come in like classification or what we know about the market. I mean, in a general sense, most of us here come knowing we don't know. We use tools, statistics, sample size to find out closer what we can know. And if you do extra Monte Carlo for a robustness test, you become even more confident in that. So if you can apply this to other areas of knowledge, whether that be science, but also finance as well. How well do I know how much this strategy's idea or underlying factor we have confidence in? And that is something that we should explore because it's changing all of the time, right? And then that can give you a gauge of when maybe something is changing too much outside of bounds. I think that when you consider your level of uncertainty, it doesn't necessarily improve your accuracy in the statistical sense. I mean, it may, but in the mental model sense, it does for sure, because you are able to start asking the right questions, whether that be of data or of yourself. And then you're able to narrow down, say, outsized cases that you can kind of like red flag, if that makes sense.
Yeah, it makes sense. So are you trying like I understand the first part of your statement and the fact that we can improve our measurement process and sort of figure out sort of apportion errors to the parts that comes with our assumptions and the actual error that is related to measurement or error that is related to the process itself, the data. The idea of getting more confident about becoming more precise in our measurement works as well. I don't understand how though. By continuing to doing this, we sort of improve or manage to achieve reduction in uncertainty. By definition, if something is uncertain, it's the Don Rumsfeld kind of thing. Unknown unknowns by default. You can't. It doesn't matter how much you study. You're not going to know about them. So, am I sort of getting off piste and off of a tangent here, or are you trying to say that by continuing to refine the process, this sort of learning process and learning, an investigation process, you can overcome, you can push that boundary of risk further and further away from your measurement, abilities and your measurement capabilities.
I agree with that. And I think that's why this stays in the realm of the philosophical, because you have unknown unknowns, but we have tools that help us create situations which are technically unknown. And that goes back to, the Monte Carlo thing or scenario analysis. We can build situations which have never occurred before. And then we can have less uncertainty if extremes much more extreme, you could say 5x, 10x of what we've seen in reality, and know what occurs to our systems. And that can make you prepared, but it will not necessarily tell you the outcome of the specific event that will trigger such a thing. I guess, like if we have a war in Taiwan or something, we can expect, okay, Asia is going to be hit pretty hard. We can look at, 1, 2, 3, 5x of what's ever happened before, and then that should help us as a tool guide, as a tool to identify both the risk and uncertainty. We can magnify the risk, and we can also simulate different levels to see what the uncertainty is around that risk. Going back to your models and measurement, I think that's actually really interesting, because measuring is, kind of the base of everything. We measure something, and then we try to take some idea, assumption, or processing that gives us an insight. If you're able to reduce the measurement error, it exponentially improves your both estimation of risk and the estimation of uncertainty around it. Barring that, you can actually reduce the errors in your processing. So it's like it goes up the chain. I think the example I've used before is using machine learning, DePrado, for the inversion of the correlation, the covariance matrix and the correlation. This reduces the mathematical error. So even if you had some error in your measurement, which we know happens because there is noise, because you're processing it better, you don't magnify it. So each step along of our chain of research, each step along our chain of ideation, even if you were trying to say, look at a equities factor, today I will use that example. We were talking about massive passive and the effect on indices and the effect on single stocks. There is definitely an effect there. How you disentangle that? Can you measure the amount of AUM going into these ETFs? And then you look at the dispersion between value and growth factors, because the growth is necessarily part of that feedback loop, but the value isn't part of the massive passive feedback loop and the rebalancing of indices. So we have a audited measure, basically, because these people need to publish what's the size of their funds. And so that you can reduce the measurement risk there and actually hone in on a better resultant to prove or disprove your hypothesis.
Yeah, thanks. Um, I have to really like. I think you're making a very good distinction that in your vernacular, in your thought process, in your analysis, uncertainty is a measure of variability. In my vocabulary, uncertainty is that which can't be known and is different, very different. And so, yeah, I mean, I completely understand your statements now. And again, we're being very philosophical, and I understand because it's a fascinating topic, but it's very philosophical in nature. If you want it to be a bit more practical, then you are speaking, and is no mystery, because once again we're speaking the same language, but you're being very Bayesian there in the sense that you're using the process of reasoning in an inductive way, and you're learning not just from the data, but from the process of analyzing data. So every time you run the process, you're refining it, because, as you said, and you brought about hierarchical risk parity, or correlation matrix linkage, as opposed to inversion, to as a tool to reduce measurement error. But everything now makes perfect sense, and I agree with you. I mean, it's largely what I do. The only difference in that is that sometimes I just say certain things can't be measured, and I brought up this geopolitical tension not because I want to drive the conversation and move it there, but because it's something that even for a political analyst, you can't really understand when so and so China or Russia will make the first move, and then the others will react to it. But you're right that you can build some sort of measurement around it by saying, okay, if they were to make this, then XYZ will happen and cascade events and trigger. So once again, you can measure even something that seems unknowable or very difficult to know and fathom. So yeah, I once again agree with you.
I think the geopolitical thing is actually very interesting, and that's where my idea of language, or rather Mauboussin's idea of language, is really important. An example that came to my head was something that I had discussed last year, and was the Xi crackdown in China. I had experience working in China, and I had some kind of, it didn't affect my system obviously, but I'm discussing with other PMs and other analysts. I put a number, or likely, unlikely, something like that, around my distribution of something happening. Yes, I don't know when something is going to happen, but if you can, like you said, use this Bayesian update such that the probability of common prosperity is increasing, because you start to see these speeches by Xi, in different newspapers and letters and things like that. Then or in the case of war now, we're seeing and specifically in China, not advice, but uh, him start to describe the victory of China assisting North Korea in the Choson Basin. What he's saying is that it's good to strike first, and they were able to push back the Americans, make them suffer massive amounts of losses, and actually created another communist country that follows their socialist um, ideals. Now, in that case, you can update that tail risk parameter probability and also reduce its uncertainty. So the probability has increased, and the probability that they will strike first, which was not on the table, may now be on the table. And so I do believe a precise language, and saying like unlikely as in 10%, or unlikely as in 5%, or extremely unlikely, 1%, helps us clarify even these broad, brushstroke type of analysis. Because if then you can translate that into something that will impact your portfolio and performance.
Yeah, that's true. Like knowing how much things are likely or unlikely helps quantifying values. It is the black swan. At the end of the day, is the black swan theory of Taleb, and what, in my opinion, people haven't really understood. At least journalists have not fully understood about black swans. It's not, it's not that black swans are rare. Yes, they are, but they have this ability to completely change the perception of the world. So it's where uncertainty sort of meets leverage, or meets wrong assumptions, and everything turns upside down. So yeah, you're absolutely right. Being able to quantify both probability and magnitude of certain events helps you a great deal in once again transforming uncertainty, pure uncertainty, into risk, into something that can be if not observed but inferred, or at the very least quantified. So yeah, very good descriptions there.
It does come back to the point of what is a real black swan event, what are the unknown unknowns, and this framework I outlined helps a lot with the known unknowns, because journalists, analysts, they can just drop coverage when things go really sour on their predictions. But that doesn't mean that there isn't information there while you can get it. And I'm just talking if I was hypothetically a pure discretionary global macro manager. But if you can deal with most of the known unknowns, you have shifted the negative expectation part of your distribution to the right, and you have either A, prepared your portfolio for potential additional volatility. So in both of those cases, even if you cannot remove the unknown unknowns, which will hit everybody, and as we know before, everyone's okay when equities market goes down, and that's fine because everyone lost money, and we can all go to the bar and have a drink. The known unknowns is really where you get a larger dispersion in performance from discretionary uh, PMs. It could be pure equity as well. I mean, if it was a known that Facebook might have an issue with earnings, then some people will have outperformed others if they were able to get out or not. And even if you believed it was only a 20% chance that that would have happened for such a large move, then you would have adjusted your position size accordingly. So being able to deal with the known unknowns is a quadrant that is guaranteed, unless you have very good forecasting power, the ability to disentangle. Then you can turn unknown unknowns into known unknowns for yourself, but maybe not for others. And then again, you apply the same process, and you even more enhance your decision making.
Yeah, that's always very true. Of course, being able it's like now we're shifting again, but you're describing the thought process of a discretionary contrarian manager that bets his farm on something which others don't see, and then again, it's a very good point actually. Is this uncertainty? Has the guy been lucky? Obviously, there's only a certain amount of luck one could have in achieving success and maintaining success. But was it a completely completely random event, or was it something that he was able to harness before? And then it's a very very good it's a very very good analogy once again.
I think we can bring this back. I want to also focus on the statistical side of things and the practical side of things, because it came up in previous clubhouse, and I think it was maybe Andy who mentioned it, but the gray box black box model, and I had put it on the poll before, and we'll see when it gets a hit. But this is where maybe that quantamental style, or the gray box, can have additional benefits. And if you were able to identify precursors ex post and then see if they have something, some kind of inference. And I think that a good example of this would be like inversion of the yield curve or something, or inversion of the VIX curve. Then you could systematize it. Then you would be able to do something. But I do believe it comes from the idea that something is going to go wrong, and you have been able to take an unknown unknown, turn it into a known unknown, and see how potentially other systematic indicators develop. And then once you are able to do that, potentially you have something that is statistical in nature, and then it can be applied to your strategies, or it could be a strategy all on its own. But turning these discretionary ideas, I think, because we've been talking about geopolitics, maybe is something for natural language processing or something. And I think people are doing that. I don't think that necessarily all the time they're getting it right, because we know that Bloomberg released a bad headline, retracted it, but they retracted it, I think, on a Saturday or something, and it was after the market closed, so it was okay. But it's those types of events that I think there are people out there who are doing something like this with the news version. I am not, but that would be where I see that.
Oh yeah, no question. I mean, NLP is really really big in finance. It's something I don't do because I don't understand the linkage between certain models and certain conclusions. But yeah, I mean, like Renaissance claim that half of their money was made by reading news and um, you know reacting accordingly. So yeah, I see a lot of that. Back on the, it's interesting then, this gray box, black box, and quantamental. With yield curve, the problem I see in looking at yield curve modeling before and sort of deriving strategy is the usual things. Like, for example, if you took forward rates, a lot of people have tried to extract predictability out of forward rates and found out much that disbelief or that despondence if they lost a lot of money, they don't have that. Forward rates don't have that predictive power. Forward rates are simply a mathematical relationship between different points on the curve, and the fact that they have to sort of obey some sort of arbitrage relationship, but they don't really tell you much. And so all this forward premium or term premium doesn't always translate in tradable strategies. So some of those quantamentals, in my opinion, are sort of traps. So you think you have a strategy, but it doesn't work. And so we're back to, isn't a more simple, I'm sounding like Jerry now, but isn't a more simple approach, which doesn't necessarily attempt to produce a forecast, but only focuses on measuring signals and precision around that signal, isn't that simply better because it's less error prone?
My default answer is always going to be simpler is better. We are definitely discussing on the edge of, well, at least my knowledge, but I'm always looking for ways to improve that. Now, I do know a successful quantamental manager. He is fully systematic as far as I can tell, and has had some struggling times because of these things you mentioned, but has been successful for well over a decade. And there does seem to be information contained within that, and whether or not you'll be able to turn it into a signal, or whether you're just able to adjust your, let's say, return distribution. Either way, it will give you more of an edge than you had. And just from the philosophical approach, being able to reduce down these things to even things that are potentially unmeasurable gives you clarity of system development and thought. And I like to explore these more philosophical ideas because, I mean, obviously I'm looking for fertile ground, and I think that that's where it comes from. I don't believe in just throwing data at a machine. I do think good ideas and strategies come from an intuition of the market. So if I can reduce my uncertainty, whether it's in the macro space or in a specific market space or on the yield curve, then it's a benefit. Things may get lost in translation between practical execution and not. But at least I would have explored it. It's a weak defense, but that's how I think of it.
I I like what you guys are talking about. And it definitely hits home for me. Both the gray box, black box is one aspect of it, and then the other is prediction versus what's in front of me. If I have that discussion correct, um, on the I fully agree with you need to be able to see what's in front of you. Like I have, if I know a signal is developing, but it hasn't quite crossed my threshold, it's very difficult to watch. You know, 5 second, 15-second bars, knowing, oh, if this happens, I'm almost there, I'm almost there. But there's a reason why we have these thresholds on it's not there. Is it there? It's not there. That's one of the toughest things I was struggling with a few years ago. It's not there, and you have to wait for those thresholds. Now, that being said, and it leads right into that gray box, black box, I wonder if you guys have any difficulties. I have, like as my newsletter is growing, like I don't ever want to get pigeonholed where if I get a new revelation, that I can't just include it, on the fly, and also, but that being said, I'm not going to have a new revelation every week or every month, because I've had the system going for so many years. It almost follows like an Fibonacci, or exponential, the time that elapses in between new tiny little tweaks should be expanding greatly as your system goes on. But I would hate to ever just freeze it and say that I could never improve upon anything.
I mean, I agree with that, and maybe that's the curse of being smart. Everyone in here is smart, and we all have to fight this urge. The I appreciate your newsletter. I have subscribed to it, and how we develop these new ideas and these tweaks, and then how we bring them into production and test them. And I think that that's where kind of first, it was actually Arthur who tweeted the intelligence community's version of English language to probabilities, and then I had researched it more, and then found that actually Mobison and his brother actually did a survey in the financial area, and that kind of kicked off my thinking in this whole subject. But the closer you can bring the things that you see as a human or as an analyst or whatever you want to call it into numbers, the closer you are to being able to systematize it, and the closer you are to be able to watch it. I mean, if you add something to your newsletter, I definitely won't mind. But the idea that we can begin to quantify things that traditionally people would say is unquantifiable, I think is the realm really where I'm trying to push this conversation. The harder it is to quantify, probably the more alpha that is there. Necessarily, if it's easy to access, then it's probably going to be arbed out, or it's going to become some kind of smart beta, or even in the case of massive passive, it is officially the beta. So the further out you can get yourself on that curve, and the better you're able to create a mental model on the probabilities of things such that you can feed it into a model or build a model around that, the better it becomes, the more refined it can get, and then the more you can throw other data or back testing or models at it. I have a ton of things that have not turned into systems because they're lost in this bridge. But I think I have gotten much better at identifying potential aspects that we would consider are unmeasurable to become measurable, or known unknowns, and make them less uncertain, or kind of like the mean of that distribution of risk, less undefined, such that you could potentially take something out of that. And that really was kind of the basis for my macro overlay. I know I've talked about it a bunch before, but this idea that there are things happening in different markets that are going to show macro events, and that there has been repeatable patterns in the past. Whether the next one plays out like the previous one, we know even with a civil trend following, you cannot determine whether this next trade is going to be the winner. Does help in other ways, like I said, shifting of the distribution. So that is where that overlay sits. That's how I kind of ideated about it and came up with it. So the gray box theory that Andy is discussing is like, you haven't gotten the model yet, but you have some intuition about something, and if you're able to put that human intuition into a number, then you can put it into even an Excel that can modify something, and then that's the start. If you're just think, oh yeah, it's like unlikely that this is going to happen, well, what does that mean, and how is that going to affect it? And if you are able to put numbers around that language, then you could do scenario tests for likely, very rare, unlikely, or however, and then it kind of almost becomes emergent. Like the idea can emerge from that because you can see different effects. So it's like you working with the data and your idea at the same time, rather than just saying, I know that this is a fact. I get, it's hard to explain, but it's definitely the Bayesian approach.
Well, and that's exactly what happened to me up at the since you said you subscribed, like at the 4680 cell, it wasn't. That was my first tweak in probably a year and a half, but there was something about it that felt so obvious that I needed to get out, and I couldn't quite explain it, and I I mean, I can't say never. Like, I so rarely will override my system, but something about it felt so awful. And I won't bore with the details because, a lot of people, it's, yeah, as you know, it's a language all unto its own. But, and then it took me like within 12 or 24 hours, like I realized that it was like this 2 day, again, I don't want to get specific, but I realized why it felt so weird, and now it's part of my system. So, and it's hard to do with an audience. You know what I mean?
Andy, that's a perfect example, a real practical example of what I'm trying to get at, because all of us are looking at the markets every day. I mean, I'm assuming, a lot of us are, very high level retail to professional people. And you will, after studying it, probably get some of these kinds of intuitions. And so, Andy, I'm sure you were able to, distill that into something that can be systematized. And it's probably something that, there's not a blog about, there's not like a white paper about this relationship, or maybe there is, but, it's not so common knowledge that everyone is doing it. And that's the real benefit. And I think this plays out a lot more in emerging markets as well, because of if you're not trading everything the same, but you get these idiosyncrasies, or maybe even if you're trading single companies, their idiosyncrasies. And if you're able to identify multiple historical events that will give you a sample size, and you're able to identify that, then maybe you're onto something. And that development process is really what helps the idea funnel, coming from this area that we don't know about something, but we've identified we don't know about it, and then trickling it down through our domain knowledge and through putting numbers on things, even if it's wrong. I mean, you could be off by a factor of 5. For all I know, I put 10%, and it's really 50%. But before it was nothing. Going from 0 to 10%, or going from 10 to 50%, there's a big, I mean, it's orders of magnitude different. And so you can continue to refine that, again, going back to this updating method. So once it's refined enough, then it can become part of your system. But to ignore that, I think, is well, it's not as fun, that's for sure. But you may be leaving intuitive edge on the table, because I mean, I'm sure we've all been doing this for a while. So
Hi, Derek. Thank you for mentioning my tweet about that. If someone doesn't know, so it's MI6. It's of course it involves several agencies, and they developed like a tactic to whenever they speak of some event or some sort of expectation, they assign like certain probabilities. So if I say it's extremely likely that something happens, it means it's 80%. It's if I say somehow it's highly unlikely, it means probability less than 5%. So what I found interesting is this type of communication between people who are aware of this classification, that they can communicate not only the say what is expected, but also the expected probability that I found interesting. Well, whether you can do it for an LP in general, is there a say if someone tells you, like say central banker tells you, oh, it's likely we increase rates next year, right? What is probability? You don't know. right? Because you are not certain. You some kind of okay, you can do either in cross section or in time series related to this person. What happened last time when he said like this, right? So this kind of I think it's a limit. Also, there is a limit of NLP to really try to, especially what concerns about expectations, right? That trying to infer certain probability, right? And so this is one point. And another one I wanted to mention about yield curve. So what I found interesting sort of intersection of quantum mental strategy is when you invest in stocks, I say S&P 500 index, if you invest only when term structure is steep, right? If you say measure difference between 10 and 5-year rate or 10 and 2-year rate. So if you only invest in those periods when it's positive, right, then you actually almost double your sharp, because actually a lot of stock market losses and these token periods from 50s, 60s, they occur when the curve is inverted. Right? That is a simple. So what it does mean? It's not, of course, it's not tradable as say per se as a standalone strategy, right? That it's curve inversions occur maybe once in a while. I think last time it was a couple of years ago, or during COVID. I don't remember. It didn't invert. It was before, right? So these are very idiosyncratic events. A few times it work, right? It's more allocation. It's more sort of overlay for some tactical allocation, right? But yes, that's what I wanted. A combination of NLP, but in general, I think NLP-H is probably, as someone mentioned, is probably has been exploited. It's probably would not expect it's exploited on short frequencies. Of course, there is possibility to medium term. On a long term, it's a question. It's a question if it works.
I think you brought up a great point, Arthur, which is, I think that the curve inversion, at least from, I always remember his handle, Convexity Maven, but I think it's Harley Bassman, the guy who did the Move Index. I think when he wrote about it, maybe a year or so ago, it's happened 8 or 9 times, maybe since he did the paper. And of course, that's very low sample size, but if you see all of this, the equities having their effect on the individual result, so all of the stocks in the S&P 500, you're able to magnify your sample size, and then okay, maybe you start to do other countries as well, non-US countries. How affected are they? And so that is kind of the idea funnel of taking these words from MI6, which are obviously putting risk on geopolitical events, and then trying to take our own intuitions about certain things, and then if we put a number on it, then we can begin to measure it. If we can begin to measure it, we can begin to research it, and then maybe there is something there or not. But that gives us a much broader range of ideation that we can get through, and it doesn't necessarily, like you said, have to be a standalone system, because in my example, it's still an overlay. But being able to cut that risk, being able to shift that distribution is still worthwhile. So how we think about the sample size, how we think about the effect of these things, and how much information there is really important. I'm really struggling with this, because it is a lot about communication and the translation of what is traditionally unmeasurable. What Arthur says is 100% correct. The reason why MI6 has this is because the idea that people communicate with different probabilities, and that goes to the same of the Malbusson survey. But what your own probability is when you read those things. So you're able to use yourself as a prior and begin to build around that. And if you read it, you take your interpretation, or maybe you take consensus analyst estimates of something, and then you have a group of people making these estimates, and then you're able to start to really expand your sample size around that, and you're able to get a lot more data points. So I think that that's kind of really what I'm pushing, turning these classically unmeasurable things into something that's measurable, and then being able to structure experiments, ideas, and research around those things. And what comes out of it, I can never tell you what's the result of a research.
And that's it. I think is what you just said. I was gonna make this comment myself, because over the course of the conversation, I completely changed my stance. I came quite I had quite a rigid approach, thinking, okay, there's the boundaries of knowable and unknowable. You managed to your experience managed to completely help me. Crossing this divide is really important. That you start empirically, and you start what you have. Prior is the key word there. You start from wherever you feel like starting, and then you move forward, and keep refining your process. So thanks very much for that. On the yield curve, just not to throw a little spanner in the works. I don't know how many of you follow Jeff Snyder and his excellent work on offshore money and stuff like that, but there has been a recent euro-dollar, so offshore dollar curve inversion, and he's talking about sample size and talking about indicators. In his experience and in his research and analysis, every time there has been one of those inversions in euro-dollar curves, and it doesn't have to be at the front. I mean, it's quite difficult the way I think these inversions get detected. This time is around the 1 year mark. But anyway, along the curve, the euro-dollar curve, when there's an inversion, Jeff thinks that in anywhere between 16 to 18 months, there's a US, obviously, or a global recession. So that's another little signal. I just listened to it before as a sort of another anecdotal evidence. Maybe we should research and start quantifying and picking up those signals now that we have Derek's framework for doing that.
Thank you, Bruno. How do you spell this name? Jeff Snyder.
Snyder, Snider. He works for Alhambra Partners, and he's the best. If you really want to understand how offshore dollars work and the difference between the regulated dollar market and the unregulated dollar market, he's
Okay,
okay.
I found him. Thanks. Very interesting. So, guys, it was nice talking to you. I have to attend another call, but good stuff. Thanks.
Yeah, I've heard of him. I've listened to some of his stuff, and that's interesting you say that, because I saw today that 70% of the bond auction went to foreigners today for U.S. Treasuries. Japan now has unlimited buying power for their purchasing threshold. So that's interesting. I mean, it's definitely from the discretionary Derek the person, not Derek's algorithms method. And, is there information there? Because those published reports are, well, first of all, we can see the curve, but, say for the Japanese purchasing threshold limit, that is obviously reported in a paper, and you can just take that number and then you can figure out all the previous reports. So in the end, I want to try to bring this back to practicality, right? This idea that there is other information out there is one thing. We are bridging the gap between quantamental, bringing in more information to our systems. Then the question becomes, okay, how do I implement it? Is the juice worth the squeeze? and how much does it affect my sample size, and can it even be, one, can it be systematized? Number one, do I have enough data to make it systematized, or am I confident enough in my Bayesian prior that it's good enough that it won't like do no harm? Number one. Then, if you're able to quantify that idea enough and refine it, through experience and put those numbers on it, can it fit in something that alters your distribution, like an overlay or a tactical asset allocation, or is it even stronger and become either part of your system, as in one of many strategies, or a strategy by itself? And bridging that, I won't call it a gap; it's a chasm. At least in my experience, it's a freaking chasm. And so I don't know if other people have ideas behind this, but I would like to hear some feedback.
I'm of course, not as qualified as you are, because I've never thought of doing all that you described, but it makes a ton of sense. In theory, at least, from an intellectual point of view, it's massive. I mean, I wish I had thought of that myself, but obviously here I've got only a limited amount of horsepower up there. It makes perfect sense. I would like to start, testing ideas in this framework. And then, speaking of priors, I'm not that worried about them as long as sample size allows you to swamp it. So the question is your prior strong enough vis-a-vis the amount of data you have to work with? So maybe it's worth testing ideas that have more samples than less samples. So, rather than figuring out, what's going to happen to this and that yield curve inversion, maybe what Arthur was suggesting, looking at regimes of, certain asset classes, vis-a-vis curve shapes, it's probably giving you more data. So if you get it wrong, if you get your prior wrong, you can correct along the way. But, as a, first time I'm listening to all these wonderful ideas, they make a ton of sense to me.
Derek, incidentally, this week I've been doing some reading and trying to dig up some information about scenario analysis. And I think I was trying to figure out this platform that BlackRock has called Aladdin. And they have something there called a Aladdin Factor Workbench, in which they have this kind of scenario analysis built in, saying what happens if, central, because all rate hikes are not the same. They come in different scenarios in different contexts. So they've tried to build something or some sort of a tool where your comment about changing the unknown to a known unknown, and then they get into some bit of complex math and try and figure out what could happen, if these two events happen together versus these three events happening together, because they have different covariances with each other. And I've just started, scratching the surface, but I don't know if you guys have done any reading or know anything about that platform or anything there.
I don't know anything specifically about Aladdin other than it's massive and they recently have added crypto to it. But the idea of scenario analysis, I think, is a big tool in this kind of research process, because like you said, Anish, there's a lot of covariances, and then you can actually play with if then or if and situations, and you get to mix potential events, whether historical or fabricated, to your heart's content, and see how that could potentially play out. And by even exploring that area, you are starting to turn unknown unknowns to known unknowns, or at least the magnitude of unknown unknowns into a distribution. And again, I even though I can't tell you what that effect would be per se, or what the catalyst in the geopolitical sense would be, knowing that and having some certain probability wrapped around it is worth something. And coming up with these scenarios, I think, does use a lot of creativity, and you definitely need to have some kind of experience in the market. You can't just throw everything together. Maybe you could, and you would come out with, something incredible. But I think that's where the man-machine discretionary quant trader comes in. What do I mean by that? It's discretionary because it's what scenarios I'm putting forth into the model. It's what I believe should be important. And that still limits your unknown unknowns, because if I don't think it's important or think it's a good idea, I won't put it in. But it does shed some light on that area, and I definitely do scenario analysis myself to try to get you could think of it, the expected shortfall of these types of events. So it's like, we know, okay, there's a 5% chance of something happening, but if that happens, what's the expected shortfall? What's the expected risk I'm taking on if that event triggers? It's also important information. And one thing that was brought up earlier, which I think is quite interesting, we've been talking about this mostly from the downside, but what if you were able to come up with those upside scenarios? What if you were able to come out with the scenarios that would harness together to give you those really big outlying trends? Because this framework is built for risk. It's like in our head that it should be for risk. But tails are tails, right? So you could do the absolute reverse of this risk analysis, try to find out what are the factors that make the biggest trends in whatever you're looking at, or your system, or pushing big macro. I mean, again, we go back to this massive passive thing. It's got the biggest trends in equity history. Those types of factors could then enhance the other side of it. Instead of chopping off the left tail or understanding how big my left tail is, could you understand more about your right tail, frame your right tail, and know maybe it's better? What if you don't even make a system, but you're like, okay, these macro things are aligning, or I've got this probability that this positive event is coming. I'll use orange juice. We continue to get more freezes. We have more weather with El Nino La Nina continuing. I think OSHA said it was above 80% or 90% for next year or something. Don't quote me. But that changes something. That changes something for the agricultural complex. What's the difference between non-El Nino La Nina years and El Nino La Nina years? That is an idea that could potentially help the upside as well.
Yeah, makes sense. I've tweeted the paper to you on your tweet thread, so you can take a look when you get a chance.
Are there any questions from the audience? Anyone down there like to raise their hand and ask any questions? Again, it's an open forum.
I guess everybody's focused on the inflation number that's come the highest in 40 years at 7.5. So it's going to be fun today.
I wasn't even looking. It's just, I know the system is doing its thing. I was just focusing on the clubhouse, and I opened your paper.
I know. While I was just sending the link of the paper to you, I just happened to see that. So I was just out of the house walking, and then I came back and sort of put that link, and then I saw that ticker just go by. Anyway, our markets are closed, so we are just, it's 8 o'clock in the evening here. So
Well, I think that will wrap up this chat. Thank you guys for indulging me on my risk and uncertainty philosophical exploration. I liked. I think it gave me clarity talking about it. Number one, to be able to have people give me feedback, and I hope that others got value out of it as well, because it is definitely super high level, and the implementation hurdle is a chasm, like I mentioned. But it's just something I don't think should be ignored. So everyone have a good day on this inflation number.
Thank you very much. I think it was really good because it exposed at least me to concepts that that were completely alien before. So thank you very much.